Good morning, everyone. I'm Steve Rattner. I never thought of myself as someone who needed no introduction, but I'm apparently not getting one today. So we're going to. Everybody else, I guess, was too busy or didn't think this was interesting enough or who knows what. But thank you all for coming, because hopefully you'll find it interesting. I think based on my informal contacts with a few of you during the opening part of this, I think we have some Morning Joe fans and some other people who've seen my charts before. And so you are going to get a chart talk, and you're going to get about 20 charts, which I'm hopefully going to get through in about half of the time that we have. And then we'll open it up for discussion, questions, and reactions. And so, I'm sorry? Yes, the charts can be available. I can actually give you an email address at the end if you remind me, and I'll send them to anyone who wants them. But you know, I get asked a lot when I do Morning Joe or when I write something for the New York Times. Essentially, the question of like, if things are so good, why are people so unhappy? And so I said, okay, let's try to answer that question. I don't have a perfect answer, but I'll show you some of the puts and takes and how we got here, of like why, given that things seem to be pretty good economically anyway. Obviously, a lot of other problems in the world. Why are people so grumpy? So let's sort of baseline this with kind of what's going on out there. So if you look at something like the right track, wrong track poll numbers, which are frequent polling statistics, you can see that actually people have been grumpy for a really long time, going actually back to 2000. We're not the grumpiest that we've been. In 2008, we were grumpier, but we're pretty darn close. 16% of Americans think the country's on the right track. 83% think that it's on the wrong track. You can see in the chart on the upper right that optimism about the economy has swung around a bit after the GFC. People eventually did get a bit more positive, but then COVID came, and other than a little bump Biden got after the inauguration, you can see people have been really not optimistic about the economy. We're going to drill into that a little bit more. And consumer sentiment also did pretty well post the GFC, but again, COVID really knocked that off. And then in terms of presidential approval, Biden's at 43%, and with a 3.7% unemployment rate, you historically would have thought he would be doing much better. And actually, you can do a regression of all that kind of stuff, and you'll find that his approval rating really is out of sync with the overall state of the economy in terms of unemployment and things like that. So interestingly, people feel better about themselves than they do about their community or the country. 73% think that they are in comfortable or excellent circumstances, but as you move into their community, as you move into their country, you can see their feeling about how well finances are drops off dramatically. And similarly, you can see that in terms of their personal finances, 49% of people think their personal finances are okay. That's below. It's been averaging about 60% since 1980, but it's a decent enough number. But when you ask them how they feel about the country, you can see how pessimistic they actually are. And until very recently, we were actually bumping along at the most pessimistic since these statistics started to be required. Inflation certainly is a part of this, and we're going to talk a good bit more about that. So this is maybe not entirely responsive to the question, but I thought it was really interesting that even how you feel about the economy has become, it has been for a while, deeply political. You can see that when Donald Trump was president, Republicans were far more positive about the economy, and Democrats were far more negative. Then COVID hit, and everybody became more negative, but still maintaining that partisan kind of divide. And the moment we had the 2020 election, it switched around. And Democrats suddenly became more optimistic, and Republicans suddenly became more pessimistic. It's very interesting. You can look at polling data on all kinds of other things, and you'll see that things that you never thought were going to be partisan have kind of become partisan. So part of the answer of the core is like, but aren't things actually pretty good? There's a lot of good stuff to be said. So let's start with almost record low unemployment. We're at 3.7%. We were at 3.3% back in 1953, but that was a long time ago. So all things considered, we used to think 4% was full employment. We are really in good shape in terms of jobs. And even more remarkably, if you look at what's happened between blacks and whites, we are at a record low gap. Back in 2012, the black unemployment rate was 8.3 percentage points higher than for whites, and now it's only 1.9 percentage points higher. And we have a huge number, I'll talk about this again in a second, a huge number of unfilled jobs. We have about 1.8 jobs open for everybody who actually is looking for one. So the idea that we don't have jobs is not the current situation. And you can see this also in job participation in terms of what we call prime age people, 25 to 54, and the peak of their working years, and how many of them actually either are working or want to be working. And that dropped off obviously very dramatically during COVID, but it's come back for men almost to pre-COVID levels. And for women, it's actually, so here's another piece of good news. For women, job participation is actually at an all-time record. Now, for men, as you can look back into the 90s and 2000s, you can see it's still below where it was then. There are a lot of reasons for that that we can talk about if people want to. But there's a lot of good news, and it's also important to say that it only took us, post-COVID, 29 months to get back to the same level of jobs we had before COVID. And if you compare that to the financial crisis, it took 77 months. And a lot of that had to do with government policy and the extent to which government, having to some degree learned a lesson from COVID, really leaned in this time around. But when you put it all together, you have to think that the jobs market is pretty darn good. You can talk about wages. I don't have a slide on that, but wages, interestingly enough, since January of 2020, so since COVID hit, wages, even after you adjust for inflation, are actually up 2.5%. Now, they've been down more recently because inflation has been up and wage increases in nominal terms have been a little softer, but all told, we have gone through this whole period, including a lot of inflation that none of us wanted, and still produce positive real income growth over the last 3.5 years or so. And so people, in theory at least, should be happy about that. So the other thing to talk about is inequality, and inequality has dramatically narrowed. Let's go back and look at 2008, and you can see what happened. You can see what happened post the GFC and how the bottom 25% of people saw their incomes actually decline very, very substantially, and this led to a lot of what was bothering people during that period and a lot of unhappiness about the slowness of the recovery. But then starting even really before COVID, it turned around, and suddenly people in the bottom 25% were out earning people, or the raises were faster than for people in the top 25%. So why did that happen? It happened actually because even before COVID, we were doing what economists call running the economy hot, meaning that our unemployment rate was also below 4%, which meant that employers had to pay more for workers, and that's actually a good thing, and so it raised wages. COVID was obviously an aberration, but you can see what's happening most recently with that big jump, again, in wage increases for people at the bottom because of all these unfilled jobs and because employers have had to raise the wages they pay them. You can see the scorecard on the right. So if you look at the bottom, 3.3% overall increase in wages since the beginning of 2020. And yes, the top 25% did a little bit better. I don't quite know why the next group didn't do so well. That's a subject for further study, I guess. But most importantly, you can see the bottom half. The bottom half, 4.4% for people in the third quartile and 6.6% for people at the bottom. So again, this should be put into the category of good news. Another thing that at least I talked about a week or so ago on Morning Joe, and is really, I think, a startling statistic, is what's been happening in manufacturing. You know, a lot of us had kind of given up manufacturing for dead. I worked on the auto rescue. I saw how tough it was for America to compete in manufacturing, and you can see that this is real construction spending on new manufacturing facilities, and you can see it was kind of bumping along. You may remember that when President Trump arrived, he said that restoring manufacturing was going to be one of his highest priorities. That didn't work out terribly well. It didn't make any difference. But now you can see what's happened. And so why has this happened? This is really an example of how government can make a difference. And we can argue about whether all the policies are the right ones or too much deficit spending or this or that. We can talk about all that. But what you can't really avoid is the fact that there were really three major pieces of legislation, I think, that have played the principal role in that blue line or black line jumping up the way it does to the right. One is the Inflation Reduction Act, which includes, as you know, I'm sure everybody, lots of provisions to spur investment in climate-related activities, as well as a bunch of other energy transition things. and they provide tax credits to companies that are willing to go out and build these new facilities. And what's been extraordinary is that the uptake of those tax credits, which are just, you can just go get them just like any other kind of tax credit by doing what you're required to do, has been extraordinary. And by some estimates, the cost of those tax credits, usually a bad thing, will actually, which in this case is a good thing because it means more people are using them, could end up at 3 times what was estimated when the bill was passed. We're going to have to pay for that. That's another issue. But the fact is people have gone out there and started building stuff. So you had the Inflation Reduction Act. You had the infrastructure bill, $550 billion for new infrastructure. That creates obviously a lot of jobs in manufacturing to produce the equipment and the products that are needed to build this infrastructure. And then you've also started to see the impact of the CHIPS Act, of the semiconductor, $52 billion for new semiconductor facilities in this country, which is as much a national security issue as it is an economic issue. But nonetheless, it is going to spur construction of a lot of semiconductor facilities around the country. So far already, just in the last year, 200,000 construction jobs have been created because of this upsurge in real spending on manufacturing. So people are grumpy, we know that, and they have some good reasons to be grumpy, and let's go through a few of those. So the savings rate. So during COVID, people did 2 things. One, they cut way back on their spending, partly because you just couldn't spend money. We were all locked down, so they saved a bunch of money. And secondly, the government sent them a whole bunch of stimulus checks, which they put significant portions of in the bank. And so it created what you can see on the right in the green is $2.4 trillion of what we call excess savings, more savings than you would have expected. It's also the green on the left, more savings than you would have expected given the trend line below in the blue line. But what's happened in the last 2 years, basically, is that people have started to draw down that excess savings. Their own savings rate, which used to be around 9%, is down to 4%, and they're using their excess savings essentially to maintain their standard of living in the face of wages that are, more recently, as I acknowledged, under some pressure from inflation in terms of spending power that people have. And so at some point, very soon, that excess savings amount is going to be 0, and then people are going to have to face tougher choices, and that's not something that's going to make them happy, and I understand that. So look, inflation is obviously a big part of why people are grumpy, and so we can take a look at that. On the left, you can see 2 ways of measuring inflation, what we call headline inflation, which is the CPI number that you see that comes out every month, and it is the headline in the news story or the first paragraph in the news story. And that includes everything that you buy in the Consumer Price Index. Economists look at what's called core, and core takes out energy and food because energy and food tend to be very volatile. And as you can see, they are very volatile because headline, which includes that, spiked way up to 9% or so in the peak of the inflation and has actually come down quite rapidly to about 4%. And core has moved in a much more measured pace. It did take a big jump, and a scary jump, and it's been coming down relatively slowly. But even inside of these overall numbers, I think people do react to inflation based a lot on their everyday life. And so the biggest poster child for inflation is gasoline prices, because every time you drive down the street, you see what the gasoline price is. Is it higher today than yesterday or last week? And gasoline is still up a lot over this period of time. Car prices are up. Food, obviously, people know when they go to the grocery store what they bought last time. They might want to buy it again this time. How much more expensive is it going to be? So overall, consumer prices are up 17%, and that's a lot over this 3.5-year period. And of course, there are some things that have gone up less, like clothing, but inflation is definitely a part of why people are grumpy. The next thing that's going on is because of the inflation, of course, the Fed has been raising interest rates, and they've raised interest rates faster and higher, faster in this cycle than in any cycle really in the last 40 years or since the Fed has really been functioning. And we've had 10 interest rate increases. Interest rates have gone from almost 0, effectively 0, to over 5%, and probably more to come. And obviously that affects people who have loans and are paying interest on a variable rate, have variable mortgages, things like that. It's an expense they have to deal with. It also has an impact on the stock market for investors. There's an old saying that interest rates are the enemy of stock prices. When stock prices go up, people see other places to put their money in bonds and in other money market funds and things like that and earn more, and they take money out of the stock market and move it over there. And so literally the stock market peaked almost at about the time the Fed started raising rates. The S&P was down 18% last year, and so that cost people a fair amount of money. And this year, if you look at the headline number, the S&P is actually up 14%, and without getting into the weeds of how these indices are constructed, there are really fewer than 10 stocks that have actually driven the stock market this year. The big tech companies that I'm sure you're all familiar with, Amazon and Facebook and Microsoft, and also a company that you may have learned about recently called NVIDIA, which makes AI chips. And if you took those out, if you took those companies out, effectively the stock market hasn't done anything this year, hasn't gone up at all this year. And so stocks, so it's not been a great time for people who own stocks. We still have a problem with wage increases going up faster than they should. The Fed has set, as you know, a target of 2% on inflation. And to get to 2% on inflation, wage increases have to be in the 3.5% range, because then you have some hopefully productivity growth that keeps inflation at the 2% level. And so 5.1%, getting 5.1% down into that, let's call it again, the 3.5% range, still is an elusive target. I think most of us still believe it's going to require more rate increases by the Fed, more pressure on the stock market, a slower economy, and ultimately potentially a recession. There is no example that I'm aware of in modern history where the inflation rate has successfully been brought down to the level it needs to get brought down to without two things. First, interest rates being materially higher than the inflation rate, which they're not yet, which means potentially more interest rate increases. And secondly, a significant slowdown in the labor market. The only way this 5% number is going to go down is if employers don't have to raise wages quite as much as they've had to raise them so far and are able to moderate that. And the way they're going to do that is if they're trying to hire fewer workers, and that ratio of job openings to people looking for work of 1.8 at the moment comes down. And yes, it could ultimately potentially mean a recession. There's, again, very few examples of the so-called soft landing, very few examples of it ever having been successfully achieved, and I'm probably in the camp of those who think it won't be this time. And so the question you may ask is, well, everybody's been talking about a recession for a year and a half, and it hasn't happened, and why hasn't it happened? It hasn't happened because the American economy has motored along in good part for the reason I talked about a few minutes ago, which is some of the new policies that have been put in place in the last 2 years have materially spurred the economy. We're investing a ton of money in all these new things that I talked about. That creates jobs, that keeps the economy going, and that's a large part of why the economy is still growing, not hugely, but a little bit, and certainly why we're still creating a huge number of jobs. We also face a bunch of long-run challenges that I think most Americans kind of can appreciate, even if they're not into the details of exactly what we're looking at. One that worries me, and I've been talking about it for a long time with absolutely no impact or positive effect whatsoever, is, along with everybody else, we've all been talking about it for a long time, is the state of deficits and debt. And we obviously, as you can see, if you look on the left, deficits as a percent, we look at these as a percent of the overall economy as a measurement of how stimulative or contractionary the government is. But you look over on the left in the 1980s, even 1990s, deficits were pretty moderate. We even had surpluses in the latter part of the 1990s, those little green bars, as you can see there. And then, of course, we had the GFC. We had to spend a bunch of money to deal with that. That was the right thing to do. We had COVID. We had to spend a bunch of money to deal with that. I think we can debate whether we might have spent too much dealing with COVID. I'm in that camp, but we can have that debate. And you can see how high the deficit went during COVID. And yes, we've brought it down, but the deficit last year was still $1.4 trillion, and that seems like a lot of money to me. And what's worse than that is that if you look at where it's going, with no changes in policies, if you simply assume all the policies that are out there right now that the government has, what it spends, what it taxes, and so on, just remain unchanged, the deficit over the next 30 or 27 years, I guess it is, to 2050, will rise to $8.9 trillion. $8.9 trillion seems like a lot of money to me in deficit spending. And what's even perhaps more dramatic, you probably read about I'm sure you all read about the debt default crisis and so on and so forth. That ceiling was $31 trillion. It's now, the debt is now $32 trillion. That's what they were trying to cap, or at least not have it go up so fast. But again, if you simply assume current policies, it's going to go to $154 trillion. When you get out to 2050, it's going to be more than twice the size of the economy. We just passed 1 times the size of the economy. We're on our way to 2 times the size of the economy, and that would scare me. Related to that is what's going on the spending side of the equation. If you go back to the year 2000, at the bottom, the government spent $1.8 trillion. That's roughly doubled since then, which is a reasonable pace of increase, to $3.9 trillion. But it's now on track to head, again, with current policies, to $24 trillion by 2052. And what's particularly worrisome and not good about that is the components of the spending. So the most troubling of it is if you look at interest payments, which went from 12% of our spending in 2000 down to 8% because interest rates came down so much over that period of time. Now with interest rates normalizing, we're looking at interest being 24% of what the government spends. So for every dollar it collects, it's going to spend 24% simply paying the interest on its debt. I doubt very many of you spend 24% of your income paying interest on your debt. And that will have the consequence of squeezing down spending on other things. So discretionary spending, which is everything from national parks to airports to all that kind of stuff, Labor Department, the EPA, is going to get squeezed down from 30% to 20%. And this was the big focus of the recent debt ceiling debate because it's the one thing that Congress can control easily. And then, but mandatory spending, which is Social Security and Medicare, is going to go from 63% to 56%. And so we're going to be spending a lot of money on all of those things. Another problem we face is demographics. So we are roughly at our peak population at the moment, absent immigration. You need about 2.1 children per family, per woman, to maintain a population even at a steady rate. Our fertility rate is currently around 1.7, and we can debate the reasons why that's happening. And it's better than China, which is 1.2, but it's not the 2.1 that we need to maintain our population. So what the red line shows you is that without immigration, our population would peak right around now, in the next year or two, at 330 million people, and then it would go down to 290 million people. So 1 million immigrants a year is what we have historically been taking in and what we would need for the population to continue to grow at a moderate rate, and under this set of projections, reach about 390 million by the end of the century. But even if we do that, we still face a problem of an aging population. I'm sure you're all familiar with this, but essentially the baby boomers, and I was in the heart of the baby boomers, are retiring. I'm not retiring, but a lot of them are. And so it creates this dependency where the people who are working essentially have to support the people who are not working. And that ratio is 25% roughly at the moment, and it's on track to go to 55% for the year 2100. So a lot of our kids are going to be having to spend a lot of their money one way or another to support us in our old age. Another issue that I think worries people is the state of retirement savings. As you all know, we moved from a kind of a defined benefit system for many people to a defined contribution system back in the 80s, where people paid into 401ks and IRAs and those kinds of personal retirement plans in order to pay for their retirements. I personally think it was one of the worst pieces of policy change that has occurred in modern history. It took the safety net for people of knowing that they had a guaranteed pension from an employer, and they essentially said to them, you're now going to take care of your own savings, you're going to have to save the money, and you're going to have to manage your own money. And it also removes the kind of insurance aspect of pensions where some people live longer and therefore need bigger pensions, and some people don't, unfortunately, and that makes up for it. And instead, we're in this world where right now, if you look at that middle bar, the sort of salmon or whatever color that is, beige colored bar, I guess, that is the middle income. $70,000 per household is middle income. in America, and they have an average of $122,000 of savings. So if you made $50,000 or $60,000 a year and you retire with $122,000 of savings, you can all do the math. It's not really a great place to be. So I don't want to depress all of you and ruin your afternoons and create suicidal thoughts. So let me end with something before we get to questions that I think is actually very exciting, at least to me, very controversial but very exciting, which is artificial intelligence. So we've had this AI breakthrough, as people know, and these are two charts that I found pretty interesting. The one on the left, which was done with version 3.0, so a much earlier version than what's around now, was a test that they gave people just as an experiment. And you can see in the gray bar that people who took the test without ChatGPT, their scores essentially and the time they spent essentially remained the same from test 1 to test 2. Time went down a little bit, scores went down a little bit, but basically the same. Once you put ChatGPT in their hands, even 3.0, you can see that the time they spent dropped almost in half, and the scores went up very, very materially. So it was a big plus. And then the right chart, which used ChatGPT 3.5 and 4.0, which just came out recently, gave the computer a bunch of different tests. And you can see them at the bottom, the GREs, the SATs, the bar exam, and so on. And the change in results was dramatic, and I don't want to ruin the day for any lawyers who happen to be here, but ChatGPT went from a 10% pass rate of the bar exam to over a 90% pass rate of the bar exam. So we may find a lot of lawyers looking for other things, to do. And ChatGPT has brought in a lot of investment. There's $90 billion of announced projects in artificial intelligence recently, up from $90 billion, up from $5 billion 10 years ago. But look, this is a big debate because what happens to those jobs and so on and so forth. And my argument is that the only way that the economy can progress is if there's more productivity improvements. The only way you can really raise people's wages in a sustainable way is if they produce more, if they're more efficient. And that means some jobs get eliminated and some jobs get created. You know, what Schumpeter famously called the process of creative destruction in order for that to happen. And so let me remind you, let me show you actually this first, which is if you go back to before 1970, we had about a 2.4% annual growth rate of productivity from 1940 to 1970 roughly. And that was really a golden age of productivity growth. And then it slowed down, and this is, you know, there are a lot of reasons and we can debate them and not even agrees on what they are. And then it slowed down to 1.7%. We had a brief return to that sort of very attractive level of productivity growth of 2.7% in the 90s. A lot of that had to do with computers and the introduction of computers. And then it slowed down again to 1.3%. And that is not a great number because that suggests that people's after inflation incomes really can't go up by more than 1.3%. Goldman Sachs believes that artificial intelligence will push that 1.3% to something like 2.8%. It's just one forecast by one set of economists. And that would be extraordinary. And that would bring us back into what many of us remember to be a golden age for the economy and for workers. You can see on the right the effects of productivity over the last 70-so years, that the aggregate amount of hours worked has gone up, but only to 2.6, whereas the wages have gone up by 11 times. And that difference between that and that is the productivity that's been created. So in terms of the job destruction, so here's a chart I personally find interesting, which is, when was the last time anyone here talked to a telephone operator? Not recently, because there's only 5,400 of them left, down from 436,000 in 1960. And you know, they all found other jobs. Since 1960, we've had the greatest jobs boom in our history, and hard to imagine a telephone operator couldn't have found other employment. I don't think many of you have contact with railroad brake and switch operators, but it's the same pattern. But elevator operators, some of you will remember, used to take you up in an elevator. Well, they don't do that anymore. And in fact, there are so few of them that back in 1990, the Bureau of Labor Statistics said it wasn't even a profession anymore. But I want to also point out to you the left side of the chart. and how technology can create jobs. Because if you go back to 1860, when we barely had any trains, we didn't have railroad brake and switch operators. Trains came along, created a fair number of jobs. Same thing happened with telephone operators. Same thing happened with elevator operators. Back in 1880, we didn't have elevators to speak of, so we didn't need elevator operators. And so it is this process of creative destruction where some jobs get destroyed and other jobs get created. It creates a lot of dislocation. It's stuff that we do have to worry about. But the fact is that we've, so far anyway, always come out the better for it. And another way to look at it is this. If you go back to 1820, virtually everybody, 70% of the country, worked in agriculture. And today, it's about 2%, and we produce far more food than we ever produced. Why? Because of productivity. Manufacturing, as we know, is a special problem, but we've created this enormous amount of service jobs over this period of time. And one economist estimated that 60% of today's workers work in occupations that didn't exist in 1940. So we have created jobs for 60% of our people by creating new job classifications in the last 80 years or so. And I think as you look to the future, there are many jobs that are going to grow in demand. And you can see a bunch of them here are certainly things that relate to the new economy, wind turbine mechanics and photovoltaic installers and so on. We're also going to need, unfortunately, more healthcare workers as the population ages. But there are going to be jobs for many of them. And on the other hand, the jobs that are most declining will be amusing to you. Things like parking enforcement workers. We don't really need them anymore because it's all done electronically. Travel agents, data key entries, word processors, and so forth. So, and again, to end on an optimistic note, this chart goes back to the year 0. I wasn't around then, and probably most of you weren't either, but it was a pretty tough time. The entire world economy, and this is all adjusted for inflation, the entire world economy produced a couple $1 trillion of output. And you can see over the ensuing 1,600 years, that included some inventions and some progress, but over the entire 1,600 years from then, the economy only got to about $8 trillion of output. And then the Industrial Revolution, we all read about that, learned about that in school, took off, and you can see what happened to GDP. This little diamond here, I'm going to get off camera for 1 second. This little diamond here is the year I was born, and so I was fortunate enough to be right in the power curve, so to speak, of this incredible development of new technologies and new ways of living. And right now, there's a huge debate about among economists. I'm just finishing a book by a guy who's essentially arguing in so many words that everything that can be invented has been invented. That book was written 10 years ago, so we've already invented more things. And then there are the techno-optimists, of which I'm one, that believe we may not get back to 2.8% productivity growth, but we ought to be able to do a lot better than 1.3% with a lot of the exciting things that are still going on in the innovation and technology economy. So that's it. I have... deducting that very, very kind applause, I have 16 minutes and 49 seconds for questions. Yes, sir.
Thank you very much, Francis Najafi. Really very thoughtful and informative presentation. On the question of AI and its impact, there's been a number of scholars and technology professionals that are projecting that AI will have a massive impact on employment in the coming decade or two. The average number is somewhere around 50 million people just in this country. Now, you are absolutely correct that new technologies and industries created new jobs versus creating the old. However, even going back to your graph on your productivity, in the past 40 years, with the exception of 3 years, labor productivity has not corresponded or correlated with medium wages in this country. In fact, it's been totally separated. That's why the average medium wage has been around 25, and it's only gone up right now to around $32 in the past couple of 3 years. And so, I guess going back to my question, yes, AI will have a massive impact on the future jobs, but unfortunately, the type of jobs required are obviously higher educated, digitally sophisticated population, and yet the middle are being left behind. Thus the reason why we have such a political discourse. What can we do about that? Because I think that's going to be a very serious structural problem.
Okay, that's a great question. Let me say two things. First, the reason I went back to this slide is to just remind everybody that in the last 2,000 years plus, there has never been a time when we have not adjusted to these introductions of new technologies in a really positive way. Every one of these things, and obviously this is a fraction of what we actually have invented, has created, in the end, more jobs. And the process by which it creates more jobs is it lowers the cost of products, makes them cheaper because they're made more efficiently or they're better. And that gives people more spending power. They go out and spend that money. That creates more jobs and then fills in the jobs that have been lost. Your question, I kind of thought somebody was going to ask me about the disconnect between wages and productivity. I didn't know it was going to be the first question, but I actually had one other slide that I stuck in here because I figured it would come up. And so you are correct. What has happened, and it's not quite as bad as some of the charts that you might see would show, but I think this is the right way to present it. What you would see that is in the last 20 years, as you said, wages and productivity have become somewhat disconnected, and this is really not a good thing. I guess you can go back to the first part of it and say, well, why were they connected for so long? And they were connected for so long by a variety of both structural situations as well as government policies. For example, we had far more robust unions than we had today, and they were able to go in and bargain for their share of the productivity increases. We had many, and going really all the way back to 1940, we had many government programs instituted to make it easier for people to live in terms of more progressive tax policies, other government social welfare programs, and so on and so forth. And in the last 20 years, we've kind of lost track of that. And so I do think that we need to get that back on track. I think running the economy hot, as I talked about, and what it does to wages for people at the bottom is going to be, has been already a significant part of it in narrowing income inequality. But it's a real challenge, and the solution to this is not to stop inventing things, not to stop using this stuff. It's for government to do a better job, and I'm going to use a really dirty word, redistribution, to do a better job of redistributing that. When some great new technology comes out, most of the people in this room are probably beneficiaries of it, and it's on us to pay a little more to help the people who are dislocated by it or otherwise negatively affected. A lot of questions. This lady in the front. Yeah.
Hi, thank you, Stephen. Joan Michelson, Electric Ladies Podcast. I actually have two questions. One is, if you can talk more about the Inflation Reduction Act and the impact on the economy and the perception of the economy, because it's creating new jobs, it's building infrastructure, it's generating tax revenue through those new jobs and new projects. So even though they're getting tax credits, it is generating new sources of revenue, and those organizations and those people are having to pay taxes, right? So I would imagine that that's also has the potential to have an anti-deficit impact. The other question I have, and I'll just give them both to you at once, is how you're using, I know you're brilliant at this, and you're using equations that have existed for a very long time, but I question whether those equations are still relevant in this economy and whether they take into account properly the kinds of technologies and productivities and, frankly, the population as well, because it's very different for women, for men, for people at different levels, and I'm not convinced that even the GDP and the GNP include the proper factors in order to create the outcomes that we want, and so much is dependent upon those equations in the economy and in people's perception of the economy.
Well, just on the second question first, yeah, look, there are lots of statistical aberrations. For example, if a woman is working at home, she does not, her work does not count as part of GDP. If she goes and takes a job, not only does her work count as part of GDP, but if she hires someone to take care of her kids, their work counts as part of GDP. So there's GDP doesn't take accurate account of product improvement quality, as well as it should. There's 1,000 statistical anomalies, but I think directionally it tells us what's going on. On the first part of your question, yeah, spending, look, the government keeps its books in a way that no private enterprise I've ever seen keeps their books. There is no distinction in the government between handing out stimulus checks and investing in renewable energy. It is treated exactly the same in the government's accounting. And obviously, the first one is just more consumption, potentially inflation. Second one could have inflation because you're incenting companies to go do stuff, and in the first instance, that could create inflation. But in the long run, it creates investment, as you say. Now, I want to be honest and say, and again, just, I was trying to limit my opening remarks to a reasonable amount of time. We haven't yet, and it won't be for a while, been able to come to a conclusion as to whether the IRA and all this stuff was a net positive or not. When you give companies huge tax credits, which we've given them, some projects are going to get built that aren't really economic. They were only stimulated by the tax credits, and they're not going to necessarily produce that much of an economic benefit. Others may produce huge benefits. But in a few years, people will go back in and look at these tax credits and decide whether it was just like handing out money on the street to things that weren't meritorious or would have gotten done anyway, or whether they really added to our stock of investment and of capital goods. So we'll see, but you're right. There's hopefully going to be some positive effect. First instance, it's going to be negative in the deficit, then hopefully positive. Somebody on this side of the room, Peter.
So I have two questions on your grumpiness indices that you showed at the top of your talk. To what extent do we think we're even asking the right questions, or we're getting answers to the questions that we think we're asking when we do these types of polls today? And then secondly, you probably saw...
I'm sorry, what's the first part?
To what extent do we think people are answering the questions that we're actually asking in these polls? And then related to that, and I think you probably saw, or you might have seen what either The Economist, The Atlantic Monthly put out recently. The problem in general, they're just not as accurate, and they may be way off. They're sort of related questions. They are related.
Okay, so look, on the polling in general, the polls have become less reliable when you look at political polls because people don't answer the phone, pollsters can't get hold of them. There are different demographics that still have landlines or still answer their phones versus the ones that don't. And so polls have definitely become less accurate politically. Again, there's lots of fuzziness in the data, and I certainly can agree that all these numbers may not be so precise down to a couple decimal points as to how people feel, but I think directionally, when you ask the same question year after year after year, and you get different answers, or people are equally grumpy, look, I think you guys obviously believe people are grumpy, or you wouldn't be here in the session, right? So I think, the idea for this session came from all these people coming up to me and saying, if the economy is so good, why are people so grumpy? And so now I'm trying to tell you, if you want to challenge the premise that people aren't grumpy, that's maybe a different panel in a different room. But in this room, we're going to try to address the fact that people really are grumpy. And you look at these right track, wrong track numbers, 13% of the country thinks we're on the right track. That's really depressing. This gentleman in the plaid shirt.
Constantly cut expenses, but are we starving our revenue stream by our tax policy?
The answer is yeah. I mean, this is my opinion, but we have been since 1981 in basically a tax-cutting mentality. There have been some tax increases along the way. But look, I started my working career right around then, a little bit before that, but let's just call it then. And my marginal tax rate on my earned income was 50%. And today, my marginal tax rate on my earned income is 37.5%, or 37%, maybe 37.5%. And so why am I paying 13 percentage points less on, frankly, a good bit more income than I paid when I was just starting out in the working world 40 some odd years ago? I'm a believer in free enterprise. I'm a believer that less government is better than more. I don't want to see government occupy the same size in our economy as it does in Europe and some other places. But I also think running these deficits is completely irresponsible. We're screwing our kids, basically. They're the ones that are going to have to deal with this in terms of paying our retirement because we're not leaving anything behind for them in Social Security trust funds, paying our Medicare because we're not leaving anything behind for them then. So, so my my base case would be that we need a good bit more revenue. We definitely need a good bit more revenue. There's not that much spending I would cut. You know, I think you get into the entitlements, there's probably some stuff you could do without hurting people that would save a lot of money. But I think our spending rate is not that crazy for an economy this developed, this size, and this rich. It's our revenues that are really out of whack. How about somebody in the back? This gentleman on the aisle.
You showed a graph with the dramatic increase in the service component of our economy, and then you showed a separate one that showed an arguably anomalous blip in manufacturing investment because of recent legislation. My question is that given the fact that manufacturing migrated offshore principally because of the dramatic differential in labor rates, to what extent does AI afford the prospect of those differentials being compressed and therefore the manufacturing portion of society growing dramatically?
Yeah, that's a great question. That's a great question. Look, there's no doubt that we lost a lot of manufacturing and we didn't invest much in manufacturing for a long time because of competition from much cheaper foreign labor in China and other places like that. And frankly, as well as workers who over time became very, very efficient and productive. When I was working on the auto rescue, I learned that the auto companies felt that their workers in Mexico were just as productive as the ones in the US, and they paid them 15 or 20% of what they paid them in the US. So it's like not a surprise that manufacturing would migrate away. I think there's a real question, and I kind of alluded to it, but I'll be slightly more specific now, about whether all these incentives for manufacturing are going to work out. If you talk, for example, to the chips companies, semiconductor companies, they will tell you that the cost of operating here is 50% higher than it is back in Taiwan or Korea or Japan or Singapore. And it makes no real, there's some national security things we can talk about, but as an economic matter, it makes no sense to be subsidizing uneconomic production. So we have to get more efficient. We have to fix the permitting process, which is a disaster in this country. And we have to use technology like AI to make people more productive. And if it means there are not quite as many workers in that chips factory, that's the price we have to pay to make that chips factory economic. In the long run, it makes no sense to subsidize uneconomic factories, or anything for that matter. How about this guy in the white hat, or lady, I can't see. Oh, Steve, I can see you, and I know you.
Yeah.
Well, Steve, you know more about this, so you want to come up here and answer your own question? No.
Steve Roach, I used to work with Steve a long time ago, and excellent job in really bringing the economy to life. The issue of grumpiness, though, as you laid it out at the beginning, is fairly recent. And you make a compelling case that you would attribute a lot of that to the fiscal authorities. I would make an equally compelling case that the monetary authorities deserve blame for reckless zero interest rate, quantitative easing for much longer than we thought, setting this up for the inflation that they now have to try to grab control of. Add to that the polarization of the political process. And to me, just your comment on this, the grumpiness seems to be that the government stewardship of our system has failed, and Americans recognize that and have no confidence in the government's ability to make things better for us.
That's all very well said, and I agree with most of it. So, I don't know how many people here, took monetary economics in college. I don't want to turn this into a monetary economics panel. I don't think all of you would be here if that's what the title of it was. So let me just say a couple things. First, where you and I might disagree a little bit, but I don't want to get into it here, and you probably don't either, maybe you do, is the period from 2009 until very recently, when we did have a lot of quantitative easing, when we kept interest rates at zero, in my view, was exactly the right policy, because we still had an enormous amount of slack in the economy, and inflation was quiescent, and it was our job, the Fed's job, to get the economy back on track. The mistake the Fed made, and it was a huge mistake, it was a consequential mistake, and probably because people aren't that sophisticated, they pin a certain amount of this on the White House, even though the Fed is an independent agency, as you all know, was that they responded to COVID too aggressively, that they took the 2008 lesson of not doing enough, and they said, and there was a stock phrase that Jay Powell and all these guys were using, which was, it's better to do too much than too little. And it turned out it wasn't better to do too much than too little. And between what the Fed did with quantitative easing during COVID, not the earlier period, and keeping interest rates and reducing interest rates to zero, had gone up a little bit, and some of the stimulus, which was excessive in my opinion, we created a lot of this inflation. Now, if I don't say that inflation was a worldwide phenomenon, my wife, who's right over there, is going to get up and tell you all why this was not our government's fault, but just part of something that happened. I think, again, I don't want to get too deep into the weeds on it. We have the most flexible, vibrant economy in the developed world. We did not need to have this much inflation. We do not need to have as much inflation as Europe. There were policy mistakes that were made, and Steve, I think you're right that they feed into this current grumpiness. Gentleman in the pink shirt on the other side of the aisle.
The chart that you had that showed the percentage of debt going to 200% of the economy, down at the bottom, there were some percentages so you could calculate kind of the size of the government spending. National debt, but size of government down at the bottom. And the government spending goes up like fourfold over the next 20 years without policy changes. I might not have the right number, but it's a big increase in the size of the government. What's driving such outside growth? The government, it's spelled out. It goes up sixfold. Total outlays go up sixfold in 20 years. It went up, twofold in the last 20. What are the policies that are driving that need to be altered?
Well, the first, in no particular order maybe, but in some order, the first is our debt. You accumulate more debt, there's nothing you can do about that. Nothing, nothing, nothing. And there are many people who feel that the interest rate projections that the CBO uses in these numbers are too low. It's actually going to be worse than this. The big enchilada is the 56% on the right. And that's Social Security and Medicare principally, as well as a few other programs like that. And that's where the money is. Willie Sutton was once asked, why did he rob banks? It's because where the money was. And if we want to really attack our spending, we have to get into that. And hopefully we can do it in a way that is not harmful to people. For example, we can have means testing of Social Security. I'm getting Social Security right now. I don't honestly need it financially, but I'm entitled to it, so I'm getting it. There's no reason for that. The whole system with healthcare and Medicare and what it spends and the lack of any discipline or rationing, and I will use another ugly word to some people, of healthcare, keeping it affordable, is another huge problem. And we do a fair amount of biotech investing, and I can tell you that the drug therapies that are coming are very exciting. Many of them target, though, fairly rare diseases at unbelievable cost that's going to get paid for by the government. And we have to at least ask ourselves the question of how do we make sure we're doing the right thing. Now, I've gotten the whatever you call it, yoke to pull me off the stage, so I'm going. I don't mean to end scaring you all about Medicare, but thank you all so much for coming and for listening.